Investors are not very happy with Tesla first quarter 23 result. Despite delivery growing 4% quarter on quarter, revenue was down 4% and net profit plummeted by 32% quarter on quarter. In other words, in this quarter, Tesla sold more cars in terms of volume, but due to the price cuts, the net profit and revenue suffer. To recap, the company has slashed its product prices 6 times this year. Tesla investors and owners alike have not responded positively to the price cuts. Perhaps it is because Tesla has always been perceived as a premium car maker, and being the market leader with a lucrative margin, the decision to cut price seems unreasonable. Worse, Musk told investors that he believes that Tesla could technically sell its car at zero profit and the company can instead make money from the autonomous software in the future. What is on his mind? Next, move on to DigitalCorEREIT, which was recommended in February 2023 market highlights. We saw the share price drop 30% after its second largest tenant, CYXTERA, was downgraded by Moody's from B3 to Caa2. Is this an opportunity? Hi everyone, I'm Mr. Te from The Modern Reminder. Welcome to the market highlights. In this series, I will update the interesting event that happened recently and see how we can position our portfolio according to these events. First, let's talk about Tesla price cutting strategy. The price cut is not a desperate reaction, but a move to gain market share and to drive the competitors out. The idea of cutting your price to gain market share is a tricky one because they might or might not work effectively. The fixed cost of the industry is one of the deciding factors. Think about law firms and accounting firms. The fixed costs of this industry are very low. Their main cost is the labor cost, which is a variable cost. It means that when running an accounting firm or a law firm, if you want to take more cases, you have to hire more people and your cost will be higher. That way, there isn't much cost advantage to a firm with 100 staff over a firm with just 3 staff. Because of this, there are tens of thousands of law firms and accounting firms around. In such an industry, if you reduce your cost to hurt your competitors, you are going to hurt yourself too. If you are able to somehow drive some of your competitors out of the market, there are always new entrants, because the fixed cost is low. On the other hand, the fixed cost of an EV manufacturer can be very high, especially during the initial production stages. It is because EV market is still relatively new and developing. The manufacturers often have to invest heavily in research development, equipment, and infrastructure to bring their products to market. Fixed cost is the cost they have to pay, no matter they are producing 1 unit or 1 million units. It is best illustrated with the chart below. On the left hand side, when you are only producing 1 unit, the cost is definitely going to be high due to the fixed cost. But when you produce the second unit, the same fixed cost is going to be shared by 2 units. So the more you produce, the more it moves to the right until it reaches the minimum efficiency of scale. It is the point at which the firm can achieve necessary economies of scale for it to compete effectively in the market. Tesla, being the pioneer in the EV, crossed the line in 2019 and has since been enjoying improving operating margin. However, many other EVs have not. Now you are about to see what game is Tesla playing. Because of the high fixed cost in EV industry, it takes about selling 1 million units of car per year to break even. The number is made up, it's just for presentation. Tesla is now selling 1.5 million units per year, way above the break-even point. Company L is just about to cross the line, looking forward to profit soon. Companies X and N are still struggling to reach that point. When Tesla cut its prices, the rest of the EV players have to follow, or else nobody is going to buy from them. Now with reduced price, they are going to sell more units to break even the fixed cost. By reducing the price, what Tesla did was to effectively raise the break-even line for the entire industry, say from 1 million units to 1.2 million units. Company X and N are now going to take more time to break even, and Company L, which was on the brink of breaking even, now is going to bleed further. And what happened when Company L finally catches up and approaches the break-even line again? Tesla could do the same thing, further reducing its prices to raise the break-even line again. As Elon Musk said it, Tesla could technically sell the car at zero profit. In theory, it will work. We will see much greater impact in the Chinese EV market than in the US, because in the States, the other major EV players are the incumbent automakers, so they have more capital to burn. But in China, Tesla price cut will accelerate the industry consolidation by edging out the marginal players. The EV startups like Leapmotor, Hozon, WM, or even the bigger names like NIO, Xiaopeng they will be facing great pressure because they are still burning their capital with negative cash flow. The 10 to 15% price cut year to date should have dampened their gross profit from over 10% to low single digit, speeding up the rate of capital burning. In other words, their survival will pretty much depend on their financing capabilities. We downgraded Chinese automobile sector January this year. What is the risk for Tesla in pulling this move? This strategy cannot work when the total market share is growing rapidly. There's actually a formula to it, but you don't have to know the formula to understand the concept. As a thought experiment, when you cut your product prices to gain market share and the market demand grow beyond what you can produce, the excess demand will still go to your competitors. In other words, the production capacity of Tesla is very important in this strategy. Any hiccup will render it ineffective. Move on to digital core REIT DCRU. With the continued migration to the cloud and the emergence of AI, the demand for computing power and data center will definitely increase. We made DCRU our pick to ride on this trend. However, after its second largest tenant CYXTERA, which accounts to 22.6% annualized rent, was downgraded by Moody's from B3 to CAA2, a speculative grade, the share price dropped 30% in just 2 months. How bad is it? Now just switch your perspective. If you are a landlord and one of your tenants is facing financial difficulties, it will either survive and continue to pay you the rent, or it will go default and you have to find yourself a new tenant. In either case, does it make your renting business inferior? Of course not. It is the same with DCRU. If CYXTERA filed for bankruptcy protection, the rental for that year will be impacted. But what is more important is how fast can DCRU backfill the vacant data center space. The long-term track record of portfolio occupancy for DCRU is 99% on average since 2012, and the increasing demand in data center, rising rentals, and tightening vacancy all go well for DCRU to backfill any potential vacant data center. Let's assume that DCRU can backfill 50% of its vacancies. Our estimated distribution yield for financial year 25 is 7.5% per annum based on the current price of $42. If you are super pessimistic and assume that DCRU cannot backfill any of the vacancies, the distribution yield is still 6.2% per annum. It's still pretty good. That is all for market highlights for April 2023. I like to share why some pricing strategy is more effective in capturing market share and why some are not. Maybe in the future I will make a video about that. If you have any question for us, you can click the link to the Google form below. If you like this video, do the usual, like, share, subscribe. Until next time.